Hey there, welcome to another edition of Be the Boss of Your Money. I'm Mitch Goldberg. This is my live stream. It's all about investing, personal finance, helping you to become your best version of your financial self, where we put the personal into personal finance. I have a special guest today, so we're going to cut to the chase. His name is Joe Bonacci. He is my fellow econo nerd. He's a CFA. He holds an MBA as well. That means he's very, very smart. We're going to talk about inflation. We're going to talk about interest rates. We're going to get his not just his feel for where things could go with the economy, inflation, interest rates, and the stock market, but he's going to share with us some insights, some history, and really give us a way to think for ourselves so that we could make better, so that we could potentially make better financial investment decisions. So I also want to say that while you're watching, if you like what you see, please give us a thumbs up, a heart, an applause, a wow, depending on whatever reaction you have available to you, depending on which social media platform you're watching from. It helps spread the word to all of your contacts about the good work we're doing here. It's all educational. If you have any questions at all, definitely hit us up in the comments. Hearing from you is the best part about doing this. I know Joe would love to answer your questions. So what I'm going to do right now is I will roll the introduction, and then we're going to have a really, really good show. So stay tuned and definitely wait for the end because we're going to have a lot of really good information for you. Very educational. Here we go. Let's get rid of that introduction. Joe, it's nice to see you. Thanks so much for joining me today. How are you?
I'm doing great, Mitch. Thanks for hosting.
You're very welcome, and I appreciate you making the time. You're a certified financial analyst,
Absolutely.
which is probably the hardest designation you could possibly earn in the securities financial services industry. And you're also an MBA from Pitt, right?
Absolutely. Yeah. So came out here to run the program here at Sierra Ridge. Just joined during the second quarter. Right now we have about 15 to 20 advisors in about 5 or 6 states. Great group. Very excited to have a chance to work with such a diverse group of advisors. I'm always very challenged by the variety and types of questions and problems they all pose. So it's been a challenge, but it's been a good one.
It has been a good challenge. Look, there's an old Chinese curse. I hope this didn't come off like I'm bashing anybody. Okay. It says, may you live your life in interesting times. And these certainly are very interesting times. Certainly for my career of over 30 years, I've never seen interesting times like the ones that we have right now. It seems like everything in history from 40-year high inflation to wars and Cold War, et cetera, it's all coming back to us, all hitting us at once. So my question for you is, are we doomed?
Mitch, that's a great question. I mean, you and I kind of chatted about this last week, and in fact, it's a question that we delved into at Sierra Ridge about a month or two ago. One of the things that I found fairly interesting is the fact that consumer sentiment, investor sentiment at large, is worse now than it's ever been since we started measuring that back in the early 50s. And that's a very interesting development because, Mitch, you are correct. Sentiment now is worse than it's ever been. And when we kind of contextualize that, when we look back, the current sentiment is worse than it's ever been. And then, it's worse than, 2007, 8, and 9 when we had a recession that, was calamitous.
Well, that was also the collapse of Lehman Brothers, and we thought literally the financial system would completely collapse. Yeah.
Absolutely, yeah.
Okay. So,
It's worse than 2000 and 2001 after .com, 9/11, et cetera. Worse than the recession that we had in 90, worse than the recession that we experienced in the 80s with again very high inflation, very painful recession. Kind of had a double dip, in 1980, and then a year or two afterward in 1982. So it's definitely interesting that we are experiencing an environment of sentiment that's the worst it's ever been. And I think it kind of gets back to how consumer and investment or investor sentiment has evolved. We kind of live in this world where investors have this idea where their beliefs are sort of bifurcated around the idea that if a company is not smashing records, they're gonna go out of business. And I think when we look at specific companies and specific sectors, one of the recurring themes that appears is we do see softness, but it is softness that is kind of coming down off of record performance. I mean,
right. So that's, I mean, the expectations that we have that companies will have every quarter a record revenues and record earnings, that was reflected in very high PE ratios also, because a market that's trading at a high PE ratio overall is typically a market with tremendous investor confidence. So as investor confidence wanes, we have to lower the PE ratio, which means we value lower the whole stock market in general. Is that how it works, right?
In general, yeah. So the way that investors should really be thinking about this, that multiples are important, right? It matters less about what's in the bottom, right? E for in the PE, which is earnings, or S in the PS, which is price to sales. But what those things do is that it gives us that kind of inflection point that shows us which direction the price is going. So we really think about, we would encourage folks at home who are tuning in to think about those types of things more as a barometer and less as a scale. Just because a PE is at a certain point, it doesn't mean that it's going to zig and zag, but it definitely gives us again an idea of the general direction that stocks are going.
Okay. Are we in a recession?
Absolutely not. I mean, it's very difficult to believe that we are, because again, when we look at all the macro points across the board, when we look at anything other than inflation, we see a lot of strong growth. We see, I mean, a lot of positive things. I mean, employment stats, wage growth, across the board, very strong. It's very difficult for me to believe that when we look at those two things that we're in a recession. I mean, I think one of the things that people forget is that the comparisons that we're seeing are a little tough to beat, because again, what I mean by that specifically is in 2021, coming out of COVID, right? GDP growth was artificially high. Why? Because it was being compared to 2020, when it was artificially low. So what's going to happen here is that naturally in 2022, it's going to have an artificially high comp to actually beat, compared to 2021. So it's a little inaccurate to think that just because GDP may be going down year over year, that we are going to experience some type of softness. I think what really is occurring is more of a situation where I think that the financial data is kind of smoothing itself out.
Right. We need to let 2021 and probably the first half at least of 2022 roll off, so we can start looking at more what we call it normalized numbers again. And by the way, for everyone who's watching, if you don't mind, give us a thumbs up or a heart or something. I could see who's out there, and it helps spread the good word of the good work that we're doing here. If you have any questions for Joe, ask in the comments or just say hello. Words of wisdom and encouragement are always appreciated. Inflation. Are we in a new normal of permanently high inflation, or does inflation actually go back down the way, if you look at Jeff Gundlach from Double Line, the Bond King, and a few others are pushing in the notion that inflation is about to collapse. A lot of people are actually pushing that. A lot of people aren't. So what do you think?
Great question. I mean, it's one we receive from advisors and clients constantly. What's going on with inflation? Where do we go from here? And I think when we look at, I mean, again, when we've talked about this, a lot at Sierra Ridge. I think the composition of it has been changing, right? So early on, coming out of COVID, most of the inflation was around businesses that sell things, right? Businesses that sell goods. Now we've really started to see inflation kind of evolve towards companies that are selling services. And that makes sense because when we look at companies like, Target, Walmart, all the retailers, one of the recurring themes and recurring comments that you hear from the retailers is they did a poor job of managing the inventory that they have on their shelves. They've overstocked. They anticipated greater demand. Now what's happening is that demand is softening. We're beginning to see that kind of normalization, right?
We're shifting from goods to services very quickly.
Absolutely.
But corporations were still betting on high demand for goods. And
Absolutely.
now Target is marking down TVs just to get them out of the store now.
Absolutely, yeah. And as a result of that, I mean, we've now kind of seen inflation kind of evolve and change in terms of the composition. So I definitely think that I don't think that inflation per se is going to be coming down in so much as I think just the composition of it's going to change.
Okay, so anecdotally, I just bought airline tickets and they were way cheaper than I expected. Everybody's telling me how I'm going to pay through the nose.
Sure.
But I do see some services things going down as well. Is there any evidence of that, or is it just my own little experience that is not shared by others?
Yeah, I mean, I think it's a little bit of both. I mean, when we look at services, it's going to be a little bit of a mixed bag. I mean, I think when we get into things like services in the IT sector, you're definitely going to see some firms that have a lot of pricing power, and they're going to be able to pass those costs on to end use customers. Whereas when you kind of get into some of the more commodity businesses, those service-centric companies may not have the same pricing power. So I think it's going to be a little bit of both, but I think it's going to be more predicated upon the industry than anything else.
Okay. By the way, I see Candace is out there. My friend Candace is out there. Hey, Candace, thank you so much for joining us today. And folks, if just give us a thumbs up or something, and I could see who's out there, and it's always more fun. If you're shy and you don't want to, that's okay. No pressure. So we talk about the Federal Reserve constantly. We have a Federal Reserve meeting this week.
Yep.
Wednesday at around 2:15, we expect the announcement from the FOMC, the Federal Open Market Committee, to say that it's raising short-term interest rates, the Fed funds rate, by 0.75%. I think that's baked in the cake. What's not baked in the cake is what they do after that. So what do you see the Fed doing after that? And do you see the Fed in the middle of their rate rising cycle, past the middle, or before the middle?
Well, I definitely think that the rate hike campaign is closer to the end than the beginning. One of the things that we've seen, from all the Fed districts is, commentary that they are behaving this way more because they feel they have to than because they want to. Everybody understands that when rates go up, it slows the economy down, pressure stocks. It decreases, loans for homes. These are things that these are side effects that no one wants. So it's definitely a situation where the Fed is in a tough spot. They don't want to raise rates. And I think for them, I think they're like a lot of folks. I think they're going to kind of wait and see. And I think, the problem here is that there is often a time lag between policy and implementation. So, I think at some point, all these rates going higher will have an effect, but the key is going to be when. Is that time lag going to be short?
Timing is everything in comedy and the stock
Absolutely.
market, right? Timing is everything. So Well, let me just bring in a few people here. We've got a question from colleague Bobby Bird. And what areas of fixed income can investors hunker down in during this period? I have my answer to that question
Sure.
because I see the 1 year and the 2 year at 4%, which, savings rates, money markets are still rock bottom low. So not a bad place to be for your bond allocation right now. And it's certainly better than what you're getting in the long bond on the 10 year. So what do you think?
Yeah, I think, the way that we have our clients positioned is in investment grade short uh, duration. So the idea there is that we do want to shorten up our duration, but one of the things that we don't want to do is that we don't want to increase credit risk. And I think, what happens is that very often investors make that mistake because they kind of, they shorten up their duration, which is a good thing, right? Because it insulates them from rising rates. But what happens is that they subsequently expose themselves to more credit exposure. So you want to make sure that you're kind of doing both, is that you're balancing that. So we are positioned where we're kind of moving up in credit and down toward the front of the yield curve. And for us, we feel that makes sense, not only because it's a great place to be, but for us, what types of debt is kind of resides in that area. First and foremost, a lot of commercial paper. So that's going to be a situation where investors are going to be able to ride the yield curve up, because what's going to happen is that as individual companies issue new commercial paper, it's going to be at higher rates. So that's going to be advantageous, where our investors are actually going to benefit from rising rates.
What I like to do is a laddering approach. I'll go 6 months, 18 months, 24 months, 1 year. So 6 months, 1 year, 18 months, 24 months, and I'll keep reinvesting as they mature. But, there is some value maybe emerging in the yield curve in the front end. I think investors it's the same mistake every recession. Investors become tempted by lower quality bonds or leverage products, and they wind up getting burned. I've seen this time and again. And that's
Absolutely.
why I always like to say, go stick to plain vanilla. That's
Couldn't agree
kind of my
more.
thing. Okay. Um, so let's see what else here. Could you explain what duration means when it comes to the bond market? I know what duration
Sure.
means, but I think it would be better if you explain it. And just
Sure.
so someone might say, "Well, obviously, Mitch, you don't know what it means because you're asking Joe to explain it." Just sensitivity to changes in interest rates, but I think you probably have a more nuanced answer than that.
Yeah. So essentially, what duration measures is how long it takes to be repaid. Obviously, when you buy a bond, the longer the maturity, it's going to take more time to be paid back. And kind of the other related concept is the idea that it's the timing of those cash flows. So when a person buys a bond, most of the repayment is going to occur when at the very end, because that's when they're going to get the principal back.
Right.
And they're only going to be receiving smaller increments back in the forms of a coupon payment. So if we have a 10-year bond, the duration is probably going to be a little bit shorter than 10 years. Why? Because of course most of the cash flows are going to occur when the bond is called back, it's finally repaid. So that's kind of the idea, is that duration should always historically be a little bit shorter than the maturity.
Okay. You got a quick hello from Phil. Phil, thank you very much. So nice to see you. Phil's a good friend of mine,
Yep.
and big, just very, very supportive person. And Bobby says, "Hey guys, what's up, brother?" So now I want to ask you this: as far as inflation goes, we talk about money supply a lot, and I
Yep.
think this is it's a huge topic because we all share in the national debt. Which, by the way, when we talk about the national debt, we're not even including the $9 trillion on the Federal Reserve's balance sheet.
Yep.
So the more money you print, the more supply of something you put into the world, the less it becomes valued. which
Absolutely.
means it takes more of those units to buy a gallon of milk. Inflation is does money supply explain everything ultimately, or are there other, or is it more nuanced than that?
Well, I think it's a little bit complicated. I mean, I think if you sit down and have a conversation with the monetarists, they're going to agree with you, right? They're going to say that that the value of a dollar is going to be a function of the supply and the demand, right? Whereas I think it does get a little bit more complicated because again, I think the other dynamic is, what is the sentiment of investors? Where are the relative rates? Right now, rates in the US are going up. We are a little bit higher compared to other developed countries, which obviously creates a situation where the dollar is going to be stronger compared to the euro, the
Okay,
pound.
the dollar is in more demand, so the
Correct.
dollar is surging against other currencies a lot,
Absolutely.
which should actually help tamp down inflation. A strong dollar actually typically helps bring inflation lower.
Correct.
Okay. On the other hand, from what I'm seeing is potential worries in the market is there are liquidity is being drained from the financial system, and in particular, the bond market. Do you see that happening? Is that a big worry amongst the CFA community?
Yeah, I mean, I think when we look at the supply of bonds, issuance is definitely coming down, right? Rates have gone up. Companies are definitely issuing less, so that's normal. But I mean, I think issuance, although it is going to go down, we are going to probably see a move up in quality, which I think is a good thing. I
What
think,
do you mean to move up in quality? Because we're talking about investors moving into quality, or you're seeing existing bonds move up in quality. What aspect are you talking about?
what I mean specifically is more credit-worthy companies issuing debt. So, obviously, as rates go up, the only companies that are going to have the wherewithal to actually issue debt at higher rates are going to be the premium names,
Right.
the Apples, the Microsofts, et cetera. Because again, those companies are so strong that even if rates go up, they have the wherewithal to issue new paper. So I actually think that rates going up is actually a good thing across the board because again, anybody who's going to issue paper at higher rates has the wherewithal.
What about the U.S. debt? Because now that rates are going up a lot, it's going to make the cost
Yep.
of servicing our huge budget deficit, our national debt, it's going to go up. And one of the things that the what's the word I'm looking for? The is not the MITs, that you could print unlimited amounts of money forever. There's a term for it. It was pretty popular. I've written a paper about it. I can't think of it now, but the point is the one of the excuses to run up the national debt was that interest rates are so low, so we should do it while the money's cheap. Now that the money is not so cheap, although foreign investors are still snapping up
Yep.
U.S. government debt, it does make the cost of servicing our national debt more as bonds mature and we have to reissue the debt. How does that affect GDP? Is it something that investors should worry about? I guess is what I'm asking.
Yeah, so I think if you spoke to the folks on Capitol Hill, the thing that they're going to bet on is that the economy is going to grow so much that it's going to actually lower the debt over time. Because if GDP continues to grow at a healthy clip, the size of the economy in
Right.
relation to our debt is going to kind of shrink that. So I think that's what they're going to bet on. Will that happen? Fingers crossed.
Okay, it's just the risk we take. We've got a something here, a comment or question from James Radford. Hey, James, how are you? Um, for those who are new to investing in the markets, what would be your advice to calm their fears and help them stay the course? Which is, by the way, the best question of the day.
Yeah, absolutely. Yeah, I would think that if you're just starting off, the best way to approach it is to try to index your account, because what that's going to do is it's going to allow you to kind of get a feel for how the market in general is going to fluctuate. I think one of the biggest emotional pain points that investors have, especially when they first start, is they don't really have a good feeling for how quickly prices can move. So I think trying to use an ETF like an IVV or something broad based definitely kind
Not that we're recommending it. We're just saying that as an
absolutely.
example. Got to be careful not to recommend specific securities here, by the way. You cannot invest directly into an index, but you could invest in a security that tracks or mimics index. Please go on, sir.
I apologize for that, but
No,
yes,
no
no, we
worries.
are not. Mitch is correct. We are not going to recommend the purchase of any ETF specifically. But again, I think if you move into something that's going to be broad based, that kind of behaves like the market, that's going to be a good area to start.
I always say two things about that. The first is individual stocks don't always recover, but the indexes always recover, right? That's one thing that I always like to say to get a gauge for for an investor's risk tolerance. The other thing I like to say is that the the worst thing that can happen to a new investor is being right the first time out.
Beginner's luck.
Yes, because it validates so many of the things that are wrong about investing. You bought crypto, you made a couple of bucks on it, you bought a few stocks in Robinhood, you made money. All of a sudden, you start to think, I'm actually really talented. I'm really good with this.
Sure.
And look what happened to people. And I've seen this happen with every generation. The generation before them, their parents did it in the tech bubble, right? And before that, they did it, in the 80s with the savings and loans. It just, every generation has to go through their nuclear winter in investing to become a better investor. So we're just trying to save you that trouble and give you the knowledge now so that you could potentially make better progress going forward. How's that?
Yeah, Mitch, I would agree. I think one of the behaviors that we see is definitely a pretty significant crowding into the mega cap growth space. I actually think that as rates kind of continue to go up, the valuations start to reset. I think we're going to start to see a resumption of that behavior where people really start getting back into the mega cap tech stocks.
One of the biggest risks, we're gonna have to get going in about a minute, but I see one of the biggest risks at the end of every bull market, you get into the bear market, and investors are constantly looking for the opportunity to get into the last bull market's winners. And what I've always seen is that new bull markets are led by new stocks.
Yep.
It happens almost every time. The odds of the biggest winners becoming repeat biggest winners in the next bull market is actually so low. It's pretty much unheard of. I mean, where's IBM? Where's Cisco? A few have broken the mold. Microsoft is one of them, but that's a rarity. And Apple is not one of them. People don't realize that Apple almost went bust twice before it became the great company that it is today.
Absolutely. And I think one of the things that we point out is you mentioned Microsoft. Microsoft fell on some tough times. When the business had to transition from being a PC based to being more of a cloud based enterprise, there was a good 8 to 10 years where that stock price was not performing well.
That's right. Listen, the Nasdaq peaked in 2000. It took until 2015 for the Nasdaq to regain that former peak. I mean, I don't know how many people are prepared to wait 15 years from peak to peak. However, having said that, this is why we diversify, and diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. You see how I work those disclaimers in. So I think we're going to get going now. Thanks so much, Joe. You've been wonderful. I love the way you explain things, and I hope we could do this again.
You bet. Thanks a lot, Mitch. Take care.
Kick you off my screen, and I'll speak to you soon, man. Take care.
Sounds good.
Bye. All right, so that was Joe Bonacci, CFA. He is with a firm called Sierra Ridge, who happens to be my partner and OSJ. So good guy to know. Follow him on LinkedIn, and